Hey folks, it's Iggy from the Investing Iguana, and in today's video, we're diving deep into what October's SGX earnings mean for your portfolio, from REITs to blue chips, and even CPF and SRS moves. If you're investing in Singapore or the region, this is the update you don't want to miss. Here's the pain point. With T-bill yields dropping to just 1.35%, REITs reporting earnings all month, and blue chips trading at eye-popping discounts, what should you actually do with your money right now? A quick story, just the other day, a subscriber messaged me after seeing well-known stocks at multi-year lows and asked, Iggy, is now the moment to switch from safe haven to Singapore assets? If you've looked at your CPF statement or checked the SGX screener recently, I bet you've had the same thought. Before we jump in, let me pause. The Investing Iguana was ranked 8th in Tiger Broker's 2024 Influential Tigers. We've crossed 1 million reads and 58,000 likes, and I've produced over 1,000 videos, racking up more than 600,000 watch hours as of August 2025. We bring regional and global economic trends home so you get a view that's both wide angle and street level. This video is adapted from my latest Substack deep dive, and here's our roadmap. T-bill yields, why 1.35% changes everything. October's SGX REIT results, what to watch for. Sector spotlights, retail malls, data centers, blue chips at discounts, CPF, SRS strategies, deploy or wait. A practical allocation framework, risks to watch, plus a clear action plan. Let's dive in. Picture this. You're on the MRT scrolling through your phone and the MAS announcement comes in. 1-year T-bills closed at 1.35%. Just months ago, it was 1.68%. Fixed deposits hit 1.6%. SSBs offer 1.56%. Not much competition, right? In Singapore, 2% yield barely matches inflation. But here's where our story pivots. REITs in town are yielding 5.3% on retail, 5.4% on industrial, and even 4.8% for data center REITs. This yield gap is almost 4%, the largest in 2 years, and it pushes investors toward REITs for income. But don't think it's a free lunch. With higher yield comes risk. Think occupancy rates, rental pressures, debt servicing, and swingy asset values. Imagine a simple table, T-bills on one side, safe, low returns, REITs on the other, higher returns but more bumps in the road. The October earnings are the test. Will the dividends hold up or fizzle? That's what will decide where money flows next. Quick recap, if T-bills yield peanuts, do you chase REITs for the harvest or play it safe and risk falling behind inflation? Now time for some calendar watching, folks. REIT earnings are coming hot and fast between October 22 and 29, FCT, Capital and Ascendas, CICT, Keppel DC, and Keppel REIT. Let's paint the scene. It's Sunday night, you're prepping work for the week, and that earnings calendar jumps out. What's really moving Singapore's property market? Here's what the results will show. Will optimism about lower rates fuel capital gains, or will the real numbers make investors cautious? Every REIT this month tells a story. A battle of defensive retail, industrial growth, and data center hype. Visualize an earnings calendar, bright reds and greens marking report dates. The true drama in October is the story each REIT tells about risk, reward, and the future direction of Singapore property. Let's zoom in on FCT. This year, they completed a monster buy, adding North Point City's South Wing for 117 billion. That's the biggest mall consolidation in northern Singapore. Imagine you're a tenant at North Point. Full occupancy, 9.6% annual shopper traffic growth since 2020. Business looks good. But here's the twist. FCT took on debt. Will the rental income cover the new leverage? This is what October's results will answer. An investor watching Hogang Mall's $51 million revamp hopes that DPU or distribution per unit doesn't fall. Because if it does, the market starts to ask whether this mega buy was genius or a future drag. Key question, is FCT going to justify the risk or become a warning for big asset moves in the SG market? Everyone's talking about AI these days, and Keppel DC REIT sits right at that crossroads. Its distributable income soared 57% in the first half of 2025. Revenue jumped thanks to both SG and Tokyo data center acquisitions. Picture engineers at Keppel's new Tuas facility, planning for massive GPU clusters, ultra-fast cooling, all powered by green energy. Sounds futuristic, but Singapore's power limits mean expansion isn't easy. October's results will separate hype from reality. Investors want to see occupancy rates and renewal rents hold strong. If not, high valuation gets harder to justify. With a premium to book value and a just okay 4.8% yield, growth needs to be real, not just a story. So ask yourself, is Keppel DC a genuine AI-driven growth play, or is it priced for perfection and sailing too close to the sun? Ascendas does it all: business parks, data, logistics, life science. The portfolio stretches far: Singapore, Australia, the US, and Europe. This year, portfolio occupancy was decent, 91.8%, while rental reversions held positive. Their skill? Selling US assets at a premium, redeploying into SG business parks. Imagine an investor doing maths. Debt 37.4%, mostly fixed rates. Clar's diversification is safer than most, but it's exposed to global market swings. For October, watch if overseas acquisitions pay off and Singapore assets keep the lights on. Key insight: diversification balances risk but also brings currency and global jitters. The best REITs show resilience right at home. CICT owns the big names: Raffles City, Plaza Singapura, Capita Spring. Heavyweight malls mixed with prime offices. Their challenge: navigating hybrid work culture. Offices shrink, but prime malls see a demand spike from luxury brands and tourists. Suppose you're leasing at Raffles City, rental reversion over 10%, occupancy above 96%, distribution climbing higher. That's the dream. But if the office space weakens further, the ball is in the retail court. In October, CICT's results will reveal if their diversified basket can withstand shifts in work and play. Let's walk through a typical Singapore mall: suburban, bustling, tenants ranging from NTUC to Toastbox and Guardian. These malls are almost always full because they cater to daily needs. Think of necessity spending, that's resilient. On Orchard Road, it's a comeback. Rental reversions hitting 34%, luxury brands vying for space, and international visitors packing the walkways. SG's retailers are seeing more sales, even amid renovations. But here's the reality check. Consumer spending is cautious, the economic cycle is slowing, and trade uncertainties linger. The secret sauce for retail REITs is balancing rent ambitions with tenant survival. Raise rents too high and you lose the shop. Keep them flat and your distribution goes nowhere. Imagine a table comparing sectors. Retail and data centers shine with high occupancy, while offices lag behind. Hold that table's lessons. Right now, retail isn't a sure bet, but it's a steadier leg to stand on. Here's a transition. How would you allocate between these sectors if you want to sleep soundly at night? Everyone's chasing the AI gold rush, but Singapore faces a real power crunch. Keppel DC plans a new Tuas facility, green-powered, ultra-efficient, but expansion is tightly controlled by Singapore policies. Visualize clusters of servers humming away, high-tech, eco-friendly. Still, space and energy are capped. October results will test whether data center REITs really get the bookings and renewals needed to justify their growth premium. Long-term contracts, big-name clients, and sustainable energy solutions set the survivors apart from those built on hype. Ask yourself, are you investing in real contract-backed growth or just storytelling? Hey, if you want all the full tables, charts, checklists, and the written playbook, grab my post on Substack, link is in the description below. Now for a twist, what if instead of income, you're after deep value? Hong Kong land trades at 0.45 times book value, UOL at 0.58. Wilmar's fundamentals are solid, though commodity swings have kept the stock out of favor. Picture a value hunter, patient, hunting for safety margins. These stocks aren't quick flips. Hong Kong land, for example, is recycling capital and pulling off sales at huge premiums, but faces macroeconomic headwinds in Hong Kong. UOL, as a developer and hotel operator, packs in Singapore exposure at below replacement prices. Wilmar, in agribusiness, needs the investor to stomach price shocks. Key lesson: deep discounts can stay cheap for years. These are 3 to 5 year plays for the cash portion of a diversified Singapore portfolio. Consider carefully, especially if your CPF is your emergency parachute. Singapore's CPF OA rate is 2.5% better than T-bills, but if you invest CPF OA into stocks or REITs, you'll need to beat the guaranteed rate, factoring in real risks. Here's what a practical investor asks: does a REIT yielding 5.3% cover the risk of capital loss? And for SRS, is the tax relief and deferred growth enough to put your funds out of reach till 62? Picture a decision matrix. CPFOA is rock solid but slow growing. Investment scheme and SRS offer higher upside but restrictions. If you're young, CPF, SRS in well-chosen REITs can work magic over time. But if you need the liquidity or retire soon, safety first. Best advice: don't rush. Wait for the October earnings to clarify which REITs and stocks offer real value. Ready for a framework? Here's how I suggest you think about allocation. Conservatives, 60-70% in T-bills, fixed deposits, SSBs, 20-30% in safe suburban REITs, 10-20% in solid blue chips. Moderates, 30-40% in T-bills, SSBs, 40-50% in a mix of REITs across sectors, 10-20% in blue chips. Growth chasers, 10-20% liquidity buffer in T-bills, 30-40% in data centers, industrials, 30-40% in undervalued stocks. Income-focused or retirees, 20-30% in safe havens, 50-60% REITs with high yield, 10-20% in proven dividend stocks. Picture a sliding scale, adjusting for what makes you sleep well at night. Let me quickly list what can trip up any plan. REIT dividend cuts, hybrid work hurts offices, rising vacancies mean less income, interest rate volatility, inflation could rebound, rates might swing again, watch the Fed, economic slowdown, global trade hits Singapore hard. Retail, office, and industrial demand could all drop. Geopolitical flashpoints, US-China tension, Middle East unrest. These send money flying to safe havens. Valuation risk, data centers, priced high, could disappoint. Liquidity risk, SGX is a thin market. Selling in a crunch gets hard. Here's Iggy's simple approach. Wait for earnings, not hype. Review numbers after FCT, CLAR, CICT. Keppel DC reports. Key metrics: DPU, occupancy, rental reversion, debt levels. Benchmark your baseline. Compare every REIT or stock to the risk-free 1.35% T-bill and 2.5% CPF OA rates. If you're not beating those with a fair risk, rethink your strategy. Review your allocation. Once results drop, revisit the framework: conservative, moderate, growth, or retiree. Rebalance as needed. October 2025 is where Singapore investors need clarity, not crowd following. Don't rush. Review fundamentals and make choices that fit your life today. If you learned something, smash that like button, share with fellow investors, and hit subscribe. For premium content and all my full charts, check out the Investing Iguana on Substack. Link in description. Want more? Watch my video on the most defensive SG stocks for 2025 next. Linked right over here. Until next time, sleep well, invest wisely, and stay curious.